Ladies and gentlemen, listen carefully. The number on your screen today doesn't matter. I know that sounds insane. I know you're staring at the chart. I know you're watching $79, $81, 83. And before you scroll away thinking this is just another price rant, stay with me. Because the reason the price doesn't matter is far more dangerous than the price itself. But if you're still focused on the number, you are already behind. Because today was not about a number. Today was about a message. And the message didn't come from Wall Street. It didn't come from CNBC. It didn't come from a hedge fund. It came from a man who doesn't speculate. It came from Elon Musk. While traders were fighting over ticks, while algorithms were scalping pennies, while retail was debating top or pullback, Elon Musk did something that most people completely missed. And by the time they understand it, it will be too late. He didn't buy a mine. He didn't file a disclosure. He didn't announce a partnership. He posted 4 words. This is not good. That's it. 4 words. And if that sounds small to you, pause for a second. Because 4 words from the wrong person can matter more than 1,000 pages of analysis. If you think that was casual, if you think that was offhand, if you think that was just a tweet, then you do not understand who just spoke. Because Elon Musk does not comment on commodities. He does not tweet about supply chains unless the alarm is already ringing. And he does not warn publicly unless the problem is already real. When he speaks like this, he's not speculating, he's reacting. This wasn't commentary, this was a signal flare. And here's what most people missed, and this is where the entire story flips. When Musk said, "This is not good," he was not talking about price. He doesn't care if silver is $80 or $120. He has more cash than most countries. He was talking about availability. Translation? I may not be able to get the metal. And if that sentence doesn't scare you yet, it should, because in the industrial world, that sentence is lethal. Price volatility hurts traders, but metal unavailability kills factories. And Elon Musk does not run a financial empire. He runs a manufacturing empire. Every Tesla, every solar panel, every power system, every rocket component runs on silver, not as an option, not as a hedge, as a requirement. There is no workaround here, no delay button, no substitute waiting on the shelf. Silver is not decoration. Silver is not monetary nostalgia. Silver is the most conductive metal on Earth. Physics does not negotiate. Chemistry does not care about Wall Street. And efficiency does not tolerate substitutes. You cannot build high-efficiency solar panels without silver paste. You cannot build EV power management systems without silver contacts. You cannot scale energy infrastructure without silver. And the uncomfortable truth is this. Every year we demand more of it while producing less. And here's the key point most analysts refuse to say out loud. And once you hear it, you won't be able to unsee it. There is no replacement that performs the same. Copper fails. Aluminum fails. Graphene isn't ready. If you remove silver, you remove performance. And in a world racing for energy dominance, performance is everything. So when Musk says, "This is not good," he is not worried about margins. He is worried about production stopping. And that's the exact moment the story changes. Because for years, silver was treated like a casino chip. Retail versus banks. Bulls versus shorts. Charts, leverage, squeezes. A financial game. That game is now over, whether Wall Street admits it or not. Because today, the industrial war began. This is no longer investors versus traders. This is factories versus scarcity. And factories don't care about narratives. They care about metal in hand. And here's where it gets uncomfortable, especially for anyone still thinking this is just another commodity cycle. Banks can settle losses in cash. Industrial users cannot. If a bank is short silver and the price spikes, they bleed money, but they survive. If Tesla is short silver and the supply disappears, they stop building cars. No cars, no revenue, no empire. Sit with that for a moment. That means something terrifying. Elon Musk is effectively short physical silver, not on paper, not on a screen. In reality, he needs metal that may not exist in sufficient quantities. And unlike banks, he must settle in ounces. That's why his tweet matters. Because when the largest industrial consumer on the planet publicly acknowledges a shortage, the psychology of the entire market flips, quietly, instantly, and irreversibly, from speculation to survival. And Musk didn't just speak to investors. He spoke to every CEO on Earth. Tim Cook heard that tweet. Samsung heard that tweet. Battery manufacturers heard that tweet. Defense contractors heard that tweet. And they all understood the same thing at the same time. The scramble has begun. Before today, the industry relied on just-in-time inventory. A few weeks of metal, trusted supply chains, trusted vaults, trusted refineries. That trust is now gone. And once trust breaks in industry, it never comes back quietly. Because Musk sees the same data we see and more. He sees the inventory cliff. He sees the deficits. He sees China. And once someone like him sees it, everyone else has to assume it's already real. So what happens next? This is where the panic doesn't look like panic. It doesn't show up on headlines. It doesn't scream. It looks like order size increases, quiet phone calls, private contracts, off-market deals. Double our 2026 silver order. No, triple it. And store it in our vault, not yours. This isn't speculation. This is hoarding. And hoarding doesn't raise prices gradually. It creates vacuums. Industrial buyers don't bid cents higher. They clear the book. $80 gone, $85 gone, $90 gone. Not because they're bullish, but because they're afraid. And fear in industry is far more dangerous than greed in markets. This is why silver didn't rise. It jumped. The market didn't discover value. It front-ran inevitability. Algorithms know Musk doesn't tweet unless there's a real supply problem. They know he has the best supply chain intelligence on Earth. If he sees a shortage, there is a shortage. And let's be honest, Musk is not just an observer, he's a catalyst. When Tesla added Bitcoin to its balance sheet, Bitcoin doubled in weeks. Now imagine what happens if Tesla announces something far more dangerous. Direct silver stockpiling, mine offtake agreements, strategic reserves. If that filing drops, $100 is not resistance, it's support. Which brings us to the part of this story no one wants to talk about, and this is where the clock starts ticking. Musk's concern is not abstract. It is tied to a specific date, a hard deadline, less than days away. Because on January 1st, 2026, the silver market changes forever, not because of price, because of policy. China, the largest refiner and processor of silver on the planet, is locking the gates. They call it an export licensing system. That sounds boring. It is not. In CCP language, export license means control, and control means restriction, and restriction means blockade. The fine print is brutal. To export silver from China, a company must now produce at least 80 tons annually and maintain tens of millions in approved credit lines. Those numbers are not arbitrary. They are designed to eliminate small and mid-sized exporters overnight. Hundreds of suppliers that fed Western industry are gone, disqualified, unable to ship metal out of China. So where does their silver go? It stays inside China. It floods domestic industry. It feeds Chinese EV makers, Chinese solar giants, and Chinese defense contractors. This is resource nationalism. China is saying, we make the panels, we make the batteries. Why should we export our strategic metal to our competitors? They've done this before. Rare earths, magnesium, graphite. Same playbook, same outcome. Foreign manufacturers were forced to relocate to China or lose access. Now they're doing it with silver. At the exact moment the global deficit hits critical mass. That timing is not a coincidence. That is checkmate. And Elon Musk sees it. Because even if silver is mined in Mexico or Peru, much of it is refined in China. Control the refining, control the flow. Cut the flow, and the global supply chain snaps. China controls roughly 2/3 of refined silver processing. When they restrict exports, the global price becomes fiction. There will be two prices. One inside China, where metal exists. One outside China, where panic lives. And suddenly, arbitrage dies. Western traders used to say, if London is tight, we'll buy in Shanghai. Not anymore. No license, no shipment, no metal. The silver is trapped, an industrial iron curtain, and on the other side of that curtain, Western factories are exposed. This is why $79 is meaningless. The market is trying, and failing, to price a shock that hasn't even officially started. January 1st is just the starting gun. What happens in February when a U.S. manufacturer places their usual order and receives a force majeure notice? What happens when they realize the metal is unavailable at any price? That they will rush to London, they will rush to New York, and they will discover something terrifying. The vaults are already emptying, and that's when a shortage becomes a crisis. Now let me show you why Elon Musk's 4 words were never emotional. They were mathematical. Because long before China locked the gates, long before Musk spoke publicly, the silver market was already broken. Not loudly, not visibly, but silently, structurally, and irreversibly. For 5 consecutive years, the world has consumed more silver than it has produced. Not once, not twice. 5 years in a row. In 2025 alone, global demand crossed 1.24 billion ounces. Mining supply barely touched 1.01 billion. That is not a forecasting error. That is a structural deficit of nearly 250 million ounces in a market with no strategic reserves left to tap. So where did the missing metal come from? It didn't come from new discoveries. It didn't come from miracle mines. It came from above-ground stockpiles, from London vaults, from New York warehouses, from emergency recycling. In other words, the system wasn't refilling the bathtub. It was draining. And now we're scraping porcelain. This is the sentence Wall Street will never say out loud. Stockpiles are not supply. Stockpiles are time, and that time has officially run out. Normally, when a commodity becomes scarce, the market adapts. Copper too expensive, use aluminum, platinum too pricey, switch to palladium. Wall Street assumes silver works the same way. They believe if the price rises, industry will simply substitute and move on. That assumption is dead wrong, and this is where physics executes the narrative. Silver is not just another metal. It is the most electrically conductive element known to man, higher than copper, higher than gold, higher than anything else on the periodic table. It also has the highest thermal conductivity and the highest optical reflectivity. In advanced electronics, EVs, solar panels, AI data centers, you do not get to compromise. If Tesla replaces silver with copper, efficiency drops, heat rises, range shrinks, and failure rates explode. If solar manufacturers replace silver paste, output collapses, costs rise, and panels lose competitiveness. In the energy race, almost as good is the same as losing. This is why industrial demand now consumes over half of global silver supply. Read that again. Silver is no longer a precious metal first. It is a strategic industrial input. It is the DNA of electrification, and that leads to something terrifying. Demand is now price insensitive. If you're building a $50,000 electric vehicle, the difference between $30 silver and $100 silver is irrelevant. But the difference between having silver and not having silver is existential. So industrial buyers don't wait for dips. They don't trade charts. They secure metal at any price. And this brings us to the illusion sitting at the heart of the financial system, the paper market. Because while industry is screaming for physical ounces, Wall Street is still trading promises. On the COMEX, for every single ounce of real silver in a vault, there are over 300 paper claims. Some estimates push that number to 356 to 1. Make that real. Picture a warehouse. In the center, on a table, sits one silver coin. Outside the door stand 356 people, each holding a contract, each believing they own that same coin. For decades, this worked. Not because it was honest, but because no one demanded delivery. Paper was traded for paper, fees were collected, illusions were maintained, a perfect casino. But today, the music stopped, and Elon Musk walked into the room. Suddenly, one of those claim holders isn't a hedge fund, it's an industrial giant, and they don't want cash settlement, they want the metal. So what happens to the other 355 claims? They don't disappear, they collapse, they get settled. Here's your check. Last traded price, $79. But here's the problem. You can't buy silver for $79 anymore because Tesla just took it. The real price might be $150, $200 higher. But your contract gets settled at $79. That isn't volatility, that's confiscation. And the evidence is already visible. COMEX registered inventories are down more than 70% since 2020. London vaults are down roughly 40%. Some regions now hold less than 45 days of usable silver. 45 days. That's not a buffer, that's a countdown. And this accelerates fast. If Musk bypasses COMEX, if he goes directly to miners and buys an entire year of production, he removes physical collateral from the system. Mathematically, that exposes the fraud. Remove just 10 million ounces and you invalidate billions of ounces of paper claims. Industry becomes the auditor, and auditors don't negotiate. This is why Shanghai matters. Because Shanghai is telling the truth. While New York trades paper at $79, physical silver in Shanghai trades higher. $80, $85, sometimes more. Normally, that gap would vanish through arbitrage. Buy in New York, ship to Shanghai, sell higher, easy profit. Except you can't ship it. China's export licenses kill arbitrage. Once silver enters China, it doesn't leave. That means global price discovery is dead. We now have two markets. East, physical, real, expensive. West, paper, shrinking, panicking. The Shanghai premium isn't a curiosity, it's a warning. It's the future knocking early. And now we reach the moment Wall Street truly fears. Because isolating Western markets turns every short position into a death trap. Before, banks could source metal globally. Now, they're trapped on a shrinking island. No Chinese escape valve, no emergency shipments. If delivery fails, margin calls cascade. This is where the Federal Reserve enters the story. Because silver isn't just a commodity to banks, it's collateral. Silver is leased, rehypothecated, bundled, and used to back loans, swaps, and derivatives. So when silver spikes, collateral cracks. When collateral cracks, the repo market freezes. And that's exactly what happened. That emergency $17 billion repo injection wasn't routine, it was panic. Risk monitors flashed red, a bullion bank was facing margin failure. And the Fed knew what failure would trigger. Default, clearinghouse seizure, collateral fire sales, derivative contagion, 2008, but with metal. They had two choices, let the market reset honestly or print money. They chose printing. They always do. But here's the trap. Printing money to save silver shorts pushes silver higher. Higher silver destroys collateral faster, which demands more printing. a self-reinforcing feedback loop. They are pouring gasoline on the fire they're trying to extinguish. That's why the dollar fell during the crisis, because the market understood something terrifying. The crisis isn't silver. The crisis is the currency. The Fed just placed a put under the silver price. If silver drops, physical scarcity rebuilds pressure. If silver rises, the Fed prints. Either way, silver wins. Now, geopolitics enters the room. Do you think China missed that repo injection? Do you think Russia didn't notice? They see liquidity stress. They see weakness. And they will press the advantage. Why ease a blockade when your opponent is illiquid? Why sell metal when printing dollars is their only defense? This is financial warfare. And the Fed walked straight into it. Which brings us to the unavoidable conclusion. $100 silver is not hype. It is not a moonshot. It is the industrial floor. At $100, demand is not destroyed. At $100, Tesla still builds cars. At $100, solar still scales. The only thing that breaks at $100 is the paper system. That's why volatility will turn violent. Expect smashes. Expect fake sell-offs. Expect psychological warfare. But understand this. A paper smash during a physical shortage is just a sale sign on an empty shelf. Eventually, the shelf goes bare, and when it does, the buy button disappears. That is the unobtainium phase. No dips, no charts, no access, only holders. This is the wealth transfer moment, from paper to real, from leverage to substance, from promises to atoms. Do not sell metal for a currency being printed to save the people betting against it. Use it, leverage it, exchange it for real assets. But don't trade it back into the burning building. Elon Musk's 4 words weren't commentary. They were a confession. The system is tighter than anyone admits. The clock is closer than anyone says. And the price on your screen? It's the last lie still standing. This is not good for them. But if you understand what's happening, it may be the opportunity of a lifetime. If you understand what you just watched, you're already ahead of Wall Street. And if you don't, the price won't matter when the metal is gone. This channel isn't about price predictions. It's about survival positioning.